Today we are discussing one of the biggest proposed tax shakeups for Australian property investors in many years. The Federal Budget 2026 has proposed major changes involving negative gearing, capital gains tax, family trust. Now, before we begin, very important disclaimer. These are currently budget announcement only. They are not law yet. The government still needs to draft legislation, pass it through Parliament. So please do not make emotional buying or selling decisions based purely on media headlines. The final rules may still change significantly. This is Ash from ClearTax. We help property investors simplify complex tax concepts so they can make smarter long-term decisions. Now, let's break everything down in simple English. The government says these reforms are designed to improve housing affordability, reduce investor competition against first-home buyers, encourage construction for new houses, reduce aggressive tax minimization strategies. Now, whether this reform will actually improve affordability, that is still heavily debated. But only one thing is very clear. The property tax landscape in Australia may be changing significantly. Let's start with negative gearing. A lot of people hear this term, but many investors still do not fully understand how it works. Negative gearing simply means your investment property costs you more money than it earns. For example, let's say you have a rental income of $30,000 and your total expenses is $46,000. So your net rental loss is $16,000. Currently in Australia, that $16,000 loss can usually be deducted against your salary income. For example, John earns $180K, rental loss $16,000. As per current rules, his salary $180K less $16,000, his taxable income is $164K only. This reduces his tax payable significantly, and because John is already a higher tax bracket, the refund can become quite substantial. That is why negative gearing becomes extremely popular among Australian property investors. So what changes from 1st of July 2027? Under the proposed budget reforms, from 1st of July 2027, negative gearing may become limited mainly to new builds, meaning if you buy an established property after the proposed start date, you may no longer be able to offset rental losses against your salary income. Instead, those losses only offset future rental profits or future capital gains. This is major proposed shift. Now, here is the important part. If you already own an established investment property before the proposed change, the government has indicated current arrangements may continue, meaning existing investors may be grandfathered into the current rules. Example, let's say Raj has purchased 3 investment properties in 2020. Potentially his existing negative gearing benefits continue unchanged, but if he buys another established property after the new rules commence, that property falls under the proposed new system instead. Again, we still need final legislation to confirm exact details. The government still want more housing supply, so new build properties may continue to receive full negative gearing benefits. This could include brand new townhouses, off-the-plan apartments, house and land packages, newly constructed dwellings. Example, Sarah buys a brand new townhouse, salary 160K, rental loss about 18,000. So potentially she may still offset that loss against salary income. So investor may begin shifting from heavily towards new build after 1st of July 2027. Let's talk about CGT. Currently, if you hold an investment property for more than 12 months, you generally receive a 50% CGT discount. Let's take an example. Let's say purchase price for a property is $700,000. You sell it for $1.2 million, capital gain $500,000. Under current rules, 50% discount applied, meaning only $250K becomes taxable. This has been one of the biggest wealth building tools in Australian property investing. Under the proposed reforms, from 1st of July 2027, The government wants to replace the flat 50% CGT discount with an inflation-based discount system and proposed minimum 30% tax on capital gains, meaning only the real gain after inflation may receive concessions. Now, this could result in higher taxable gains or capital gains, higher tax payable, and lower after-tax profits, especially for long-term investors, high-growth properties, and multiple property investors. Very important clarification. The proposed CGT changes are expected to apply only to the gain arising after 1st of July 2027. If part of your property growth happened before that date, the portion may still remain under the old rules. This is an extremely important area where detailed tax planning may become critical. Another interesting proposal, investor in new builds may potentially get a choice. Use the new inflation-based CGT method or continue using the existing 50% CGT discount. The government is clearly trying to encourage investments into newly constructed houses. Now, let's discuss family trust. A lot of investors currently use discretionary family trusts because they provide asset protection, estate planning flexibility, income distribution opportunities. Example, if family trust earns 200K, instead of one person paying all the tax, income may be distributed between husband, wife, adult children, other beneficiaries. This can significantly reduce total family tax. Under the proposed reforms, from 1st of July 2028, the government is proposing a minimum 30% tax on discretionary trust distributions. The idea is to reduce income splitting strategies used by higher income earners. This could impact property investors, business owners, professional families, and investment groups. Now, there is some good news here. The government is proposing 3 years of rollover relief starting from 1st of July 2027, meaning if investors or businesses need to restructure their trust arrangements, there may be a window to do so without triggering major tax consequences. That restructuring window could become extremely important for strategic planning. My thoughts as a property tax advisor, this budget is clearly trying to reshape investor behavior. The government wants less speculative investment into established housing, more investment into new construction, less tax-driven investing, but investors should avoid panic. Property investing is still a long-term game. Australia still has strong population growth, rental shortages, immigration growth, housing demand. Going forward, tax planning becomes even more important. Investors should focus more on structure selection, cash flow, debt management, rental yield, exit strategy, and long-term wealth planning, not just the deductions. Final reminder, these changes are not law yet. They still require draft legislation, parliamentary approval, final technical rules. And the final version may change significantly, so stay informed but avoid emotional decisions. If you found this video useful, please like, subscribe, and share this video. And if you need help with property tax planning, negative gearing, capital gains tax, family trust, or cross-border tax planning, feel free to contact our team at ClearTax. Thanks for watching. I'll see you in the next video.